What's happening, Denver? I'm Tom Sagona. Working as a real estate broker in Denver, I get asked a lot of questions. Questions like, how's the market? What should I do? What's going on? Is now a good time? Now, why anyone thinks I know anything useful is beyond me. But between sampling microbrews, grooming my beard, and inhaling deep breaths of fresh mountain air, I do my best to stay in tune with the latest goings-on so I can pass the info on to you. But before I begin, this video is intended for informational purposes only. While I am a licensed real estate broker, I am not a lawyer or financial advisor. Nothing in this video is intended to be taken as legal or financial advice, and while all information has been obtained from sources believed to be reliable, its accuracy is not guaranteed. Furthermore, no guarantees, whether express or implied, can be made regarding possible future outcomes or events, and actual future outcomes or events may vary materially due to a wide variety of factors. In other words, there are far too many factors for anyone to predict the future with absolute certainty. So, before you make a decision based on this information, please do your own research and consult with a licensed professional where appropriate. Finally, a lot of the data I'll be sharing with you is specific to the greater Denver area. Markets can vary greatly from one location to another based on a wide variety of factors. So if your real estate interests are located elsewhere, you could be looking at a completely different picture, which is why it's so important to consult with a real estate professional who understands the local market relevant to you. Now, back to the video. There are a lot of factors at play in the Denver real estate market right now, but one thing is at the top of everyone's mind: the interest rate. In August, Fannie Mae released a forecast telling us that the average 30-year fixed mortgage interest rate would likely begin to come down by the end of this year and drop into the low fours by mid-2023. The following month, however, they changed their tune, predicting that rates would keep going up through the end of December and likely stay in the mid-fives all next year. Now, the October forecast tells us rates will likely climb into the high sixes and stay above 6% until 2024. So what changed? Well, the truth is, forecasting anything right now is extremely difficult because there are a lot of things going on. Untangling them all would take a much longer video, but one thing is clear. Despite recent rate hikes and a variety of other efforts, inflation still continues to be a problem. Although it has technically gone down over the last 3 months, it hasn't gone down nearly as much as many had hoped, with the percentage change in the consumer price index year over year remaining stubbornly above the 8% mark in September for the 7th month in a row. So, not surprisingly, the Federal Open Market Committee announced another interest rate hike on September 21st. Along with their economic projections, the committee raised the federal funds rate another 75 basis points, which now brings the rate above 3%. During the press conference, Federal Reserve Chair Jerome Powell stated, "My colleagues and I are strongly committed to bringing inflation back down to our 2% goal, and we anticipate that ongoing increases will be appropriate." When asked how long it will be before the rates start to come back down, he replied, "In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that." However, not all of the speech was doom and gloom. Subtly pointing out that things could be a lot worse, he reminded the public, despite the slowdown in growth, the labor market has remained extremely tight, with unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising an average of 378,000 jobs per month over the last 3 months. So, if employment rates do begin to fall, at least we're starting from a strong point. Along with the press conference, the FOMC released their collective projections, including a dot plot of various committee members' estimations on possible future rate changes over the next few years. According to these projections, the federal funds rate could hover in the mid to high fours for most of next year, and may not come back down to its current level until 2025. In fact, many committee members indicated that they don't anticipate the funds rate dropping below the current level until 2026 or later. Now, since historically the federal prime rate, which is the lowest average interest rate lenders offer to their most highly qualified buyers, tends to hover right around 3 percentage points above the federal funds rate, this could mean interest rates above 8% for most of next year. Of course, nothing is set in stone. In the words of Jerome Powell, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Nonetheless, the report does give an indication of the committee's mindset and is a useful guide to help understand what kind of changes might come in the future. Whatever the case may be, it seems clear the committee intends to continue raising interest rates and won't stop until they are certain it's making a significant impact on inflation. In fact, there's currently a 99% chance of rates going up by another 0.75% on November 2nd. So what does all this mean for the real estate market? Well, there's really no way to be sure. There are a lot of things at play here, and some of them are very difficult, if not impossible, to predict. For one, there's the fact that so much of the economy is determined by the behavior of consumers. Any projection that influences the behavior of consumers could inherently alter the outcome it's attempting to predict. Another difficult factor is that many of the numbers we're looking at are lagging indicators, which means much of the information we're looking at today is an indication of something that may have happened several months ago. However, with that said, one thing seems clear. Inventory is going to be a concern. So many homes were sold in the last few years, it's becoming increasingly difficult to find homeowners who want to sell their house. On the national scale, the total number of listings took a steep drop in 2020 as demand began to outpace the supply. As more and more sellers jumped into the market to take advantage of rising prices, the number of buyers continued to increase at an even greater pace, causing the total number of homes for sale to drop even lower. By January 2022, the total listing count had dropped by almost half in just 3 years. Rate hikes and fear of impending price drops have motivated one last surge of sellers to go to market in recent months, but as prices continue to fall, more and more sellers may choose to wait. While the national data for October isn't yet available, the number of active listings in Denver continues to decline. This threatens to shorten supply, which could drive prices right back up again, and certainly seems in line with the Fed's prediction that additional rate hikes will likely be required to keep housing prices on a downward trend. Which has many buyers wondering, should I keep waiting and see if the prices come back down? Well, maybe. It certainly seems the Fed is willing to do whatever it takes to curb inflation, even if it means a significant drop in the price of real estate. However, when looking at the cost of buying a home, the price is just one of many factors. Higher interest rates mean buyers are paying a higher monthly payment for the same size loan. To illustrate this, let's take a look at a mortgage payment calculator. Now, the true monthly payment would also include things like taxes and assessments, mortgage insurance and escrow, homeowners insurance, HOA dues, and so on, but for this example, we can just look at the base monthly payment. A year ago, a well-qualified buyer could have obtained a mortgage interest rate of about 3.5% without too much trouble. If that buyer were looking at a $500,000 loan, their monthly principal and interest payment would be around $2,200. Now, let's see what that payment will be if we just increase the rate by 2%. As you can see, the payment went up by nearly $600. But what if the buyer can't afford to pay that much per month? Well, in order to even get close to the same monthly payment as last year, today's buyer would likely have to reduce their loan amount by at least $100,000. That's roughly a 10% reduction in buying power for every 1% increase in rate. So now that the funds rate is up by roughly 3%, you'd expect to see about a 30% decrease in the average home sale price, right? Unfortunately, no. After the initial rate hikes earlier this year, the median home sale price actually continued to go up for several months, and as of August was down by less than 5.8% from its high in June. In fact, in August, the existing home sales median price was still up by 7.7% year over year. In Denver, the average close price actually went up in the month of September and seems to be on an upward trend in October so far as well, which indicates buyers are still happy to pay the price for a home in Denver, even in spite of higher interest rates. Of course, it may take some time before the full effects of the rate hikes become apparent. However, many buyers are operating with financial resources other than loans. Cash buyers will likely enter the market as prices begin to drop, and many will leverage other assets to help offset the rate. The September 9th report from CoreLogic estimates that homeowners in America have nearly $300,000 in equity on average, and puts the negative equity share of all mortgages in Denver at a mere 1.3%. And then there's the fact that Colorado is still a desirable place to live. The University of Colorado's 2022 Mid-Year Economic Update predicts that migration into Colorado is likely to increase in coming years rather than slowing down. So, is the Denver real estate market about to crash? It doesn't seem likely. While inflation and the promise of more rate hikes bring hope for further softening in real estate prices, the supply is still a long way off from keeping up with the demand. So, those who are hoping for a sudden and uncontrolled plummet in Denver real estate values soon may be disappointed. So, what does that mean for you? Well, based on the information we have, buyers who plan to take out a loan for the majority of their purchase seem pretty unlikely to benefit from waiting. In fact, if rates continue to go up and prices don't drop dramatically to compensate, buyers who wait will end up seeing their monthly payments increase. True, if you wait long enough, the rates have to come down eventually. But even if you wait until 2025, the rate will probably be about the same as it is right now. And based on the current balance between supply and demand, as soon as rates do start to come down, it doesn't seem out of the question that prices could end up just going back up again. So even if you do wait until 2025, you still might not end up saving. So at this point, you must be thinking, I should have bought a home last year. Well, depending on your situation, you might be right, but while buyers last year did benefit from lower rates, the competition hardly made it easy. Buyers routinely competed against a slew of other offers, sometimes competing against as many as 20 offers or more. Waiving inspection and appraisal rights was essentially a requirement, and appraisals had a hard time keeping up with the prices. So even though it was often necessary to offer way above asking, the bank would often refuse to fund the loan for the full amount, which meant buyers routinely had to bring huge piles of cash to closing. Buyers were often writing checks for $50,000 to $100,000 or more just to be able to finally close on a home. Those who couldn't meet the bill often lost their earnest money, and buyers reluctant to meet demands could bid on dozens of homes without having a single offer accepted. The median average days on market for homes in Denver last year dropped as low as 4 days, with many homes going under contract within hours of hitting the market. I personally remember arriving for showings on the same day a home hit the market, only to find a sign on the door saying the home was already under contract. By contrast, the average days on market for homes today is 19 days, and it's still going up. Multiple offer scenarios are virtually a thing of the past, and the average home is now officially selling below list price. Not only can buyers now purchase a home without waiving inspection, appraisal gaps are virtually a non-issue. In fact, not only are buyers today no longer required to bring extra cash to the closing table, it's even becoming common practice for sellers to chip in and help cover costs for the buyer. Many sellers are even offering to buy down the buyer's interest rate, meaning buyers today can still get a low monthly payment while bringing little or no cash to the table. So, how can we use this information to our advantage? Well, now might not be the right time for everyone. Yes, there are ups and downs, but you also have to consider what makes sense for you. Changing your plans to buy or sell might save you some money, but it's also important to consider the effect it will have on your financial picture and your quality of life as a whole. That said, it certainly does seem like prices will go down at least for a while, so buying a home right now that you don't intend on keeping might not be the right choice. Flips are probably off the table, at least for now, because while the data does seem encouraging overall, there's really no way to be sure how long it will be before prices start coming back up. So make sure you plan on keeping your new home for at least 2 to 3 years. And you really should prepare for the possibility that it might take 5 years or more. That being said, even the historic housing crash of 2008 recovered in less than 7 years. So even the most cautious buyers are probably safe if you think you can make your new home work in a pinch for at least that long. Cash buyers may also want to wait and see, because as we've discussed, prices are likely to go down further at some point before they come back up. Just keep in mind that while prices may be going down, buyers are still purchasing homes in spite of higher monthly payments, which indicates that demand is still strong. So prices may not drop quite as much as you hope. What about homeowners who plan to sell their current home and shift into another one? Well, assess your situation and plan accordingly. If you're dealing with mostly equity and cash and there's really no loan in the picture, it probably doesn't matter when you buy and sell as long as they both happen at the same time. Just make sure if you plan to buy before you sell, that you sell as soon as possible after you buy to avoid too much loss if the market does go down. If you'll be using your equity in conjunction with a loan, however, you'll just want to make sure you factor the increase in monthly payment from rising rates into your calculations when deciding whether or not it makes sense to wait. But for buyers who plan to purchase using primarily a loan, you may not find a better time than now. While rates may be higher than their all-time historic low, they are still well below the historical average of nearly 8%. And even though housing inventory historically tends to decline toward the end of the year, there are still enough homes on the market that you should be able to find a home that will suit your needs, at least for now. And best of all, you can reap all the benefits that go with today's far less competitive market. In fact, your seller might even be willing to chip in and help you out with things like down payment, closing costs, and interest rate. So, if you think the last situation applies to you, don't wait. Click the like and subscribe buttons down below. Share this video with literally everyone you know.
Hey, you want to see a video?
And call your real estate agent or lender today. Take a look at the numbers. You just might be surprised by what you find. If you have any questions or want to discuss in detail how all of this information applies to you, please feel free to reach out to me directly at the contact information in the description below.
Hey, you want to see a video? Hey, you want to see a video?